Hey, my name's Channing Moore. I'm the broker owner of Bayou Mortgage in Louisiana, and today I'm going to share with you exactly what we're looking for when determining if you can actually buy a home. So, a lot of times we're getting asked this question. Maybe you've had difficulty in the past getting approved for a loan. Maybe you've been told no by another lender or a bank or a credit union. Or maybe you're just curious about whether or not you're actually ready to buy a home. And we understand that the process usually is you've seen some type of property, right? You've on Facebook and a realtor posted a home and you just love it. Or you've been browsing Zillow for months now, thinking about buying a home, or your landlord finally got on your nerves, or you can't have your dog, or whatever the reason is. Usually there's something prompting our clients that say, you know what, enough is enough. I'm ready to figure out if I can actually do this. What does it take? What does it take to actually buy that home? So I'm super excited to share that today, because there's actually 3 different categories of things that we're going to look at and assess to determine if you're ready to buy a home. So without further ado, let's go ahead and jump in. So the very first thing we're going to look at is your credit score. Now, your credit score is usually one of those things that it's either good or it's not good, and you're either going to make it or you're not going to make it. And each different loan program has different requirements as far as what is required of you and your credit score. Now, there are a lot of different loan programs available that help a lot of different people with various credit backgrounds. But one thing that you need to understand up front is that if you are past due or delinquent on any type of government debt, IRS debt, student loan debt, child support, anything like that, where the government can actually put a judgment against you, you're probably going to have a difficult time qualifying for a home loan, because they can take money from you and even take your house before the bank can get it back. So keep that in mind. If you've got any of that going on, regardless of where your credit score might be, those are going to have to be taken care of before you're going to be able to purchase a home. But back to the credit score. If you have a score that meets the criteria of the loan program, then you can usually check that box off. So one of the most popular loan programs available is FHA, and FHA will actually go down to a credit score of 580. Now, we don't always recommend that you buy a house if your credit score is in the 580s, because that's going to affect your interest rate, could affect your closing cost and other things. But you can, if you had to, purchase a home with FHA for 3.5% down with a 580 credit score. And they'll actually go lower, down to 550 if you've got 10% down. But those are all worst case scenarios. Now, the other loan program, conventional, that's the other popular one that everyone hears about, requires a credit score of a 620. But I'll be honest with you, if your credit score is not in the 700s, it's typically better to go with FHA, because the payment is going to be so much higher on your home. Now, there are a couple of things you should consider before fully making that decision. The biggest one being how long you plan to live in your home. If this is absolutely your forever home and you know it and you're not moving, then sometimes conventional can be better, even if the initial payment is higher, because in the next in the next 10 years, the PMI will go away and it will save you. But for most of our clients, if you're not staying in that home and your credit score is not in the 700s, FHA is going to be the better deal if you're shopping for a home. Now, there's also the USDA loan program. Now, I don't know where you're watching this from, but here in Louisiana, many of our cities, many of our clients shopping will qualify for the USDA home loan program, as long as they don't need to live in the middle of the city, in the center of the city. So if you're okay living in the suburbs, on the outskirts of town, you may qualify for the USDA home loan, which has a minimum credit score requirement of 640. So if you've got a 640 credit score, you may qualify for the USDA home loan. If you've never heard of that, it's a zero down program. And if you'd like to know more, here's a plug. I did a full video breaking down the loan and exactly what they want. You can check that out to see if you qualify. The last loan program is the VA loan program, and this is going to be exclusively for veterans. You must be a veteran or the spouse of a veteran who died in combat or connected to a service-related disability to qualify for the loan. But if you do, the general cutoff for a VA loan is 580, although there are a lot of lenders that will work down to almost any credit score imaginable, down to a 500 pretty regularly. So if you're a veteran, you've got some really, really flexible options available to you for that VA home loan. But in general, those are the credit score requirements to purchase a home. If you want to make sure that you're in the best shape that you can possibly be, get your credit score to at least a 640, and that's where you're going to start seeing the better interest rates, the better terms, the more favorable terms for your specific situation. But if that's not possible and you've got to buy, we've got loan programs available to help you, even if your score doesn't fit that criteria. So those are the kind of credit score requirements we're looking at, and there's other things involved besides your score. Like we talked about, you can't be delinquent on any kind of federal or government debt, child support, things like that, as well as, you know, you do have to kind of monitor your collections. They won't typically deny you over collections, but there are certain specific things that we have to do if you do have collections out there that we will have to assess and figure out if you're going to be able to purchase based on that information. All right, so now that we've gotten past the credit score requirements, the next thing we're going to consider is your income. And guys, this is the most important one. Lenders will be flexible on your credit score, and they'll be flexible on the last thing we're going to talk about, which is your assets, the money you have saved up to make the home buying happen. But the income is the most important part, because it's going to determine how much you have and if you can repay back the loan that the lender is going to get for you, or that you're requesting from the lender. And your ability to repay that loan is the most important part in the mortgage process. If you don't have enough income, or the right income, or you can't use your income, then you're going to be in trouble because you can't repay that loan. And so obviously, just right up front, you know, if you are in a cash only business and you're not claiming any type of income, you're not going to be able to get approved for a home loan because you're not reporting that income. For the rest of us, we'll go ahead and dive in and explain exactly what the lenders are looking for in this area. So the first thing we're going to look at is your job history. Now, a lot of people have been told you have to stay on your job for 2 years in order to qualify for a home loan. And that's not exactly true. While it's the ideal situation that you have been employed for at least 2 years with the same employer, and it will make things easier on you, there are tons of exceptions out there that would allow you to buy a home even if you've not been in your current position for at least 2 years. In general, you just need to have some type of 2-year work history showing that you've worked for 2 years, and even exceptions can be made for that if you went to college for whatever you're in. So if you're a nurse now and you just started a month ago, but you've been in school for nursing and you graduated, that's a totally different story, and you can use that schooling to combine as part of your work history. So we're going to look at that and try to determine how stable your employment is. Now, if you've just taken a new job, a lot of times we can use what's called an offer letter to get you going on the home buying process, especially on conventional loans. But if you're going to buy a home with FHA or one of the government loan programs, typically you're going to need at least 30 days of pay stubs from the new job in order to close that loan. So it's really important, if you know there's a job change or something like that coming up, that you let your lender know, because it can absolutely affect your approval and their ability to get things done for you. Another thing that you want to make sure is that you don't have any job gaps. You know, if you've got quite a few job gaps showing up on your income over the last 2 years, and your job history rather, over the last 2 years, the lenders are going to ask about that. And a lot of times we can get around it, but the big hurdle is when you've had job gaps of like 6 months or more where you were out of work. And one, we can usually explain, maybe you were hurt or something like that. But if you have multiple job gaps in the last 2 years of 6 months or more, that's not going to look favorably to the lender. Another thing that you want to be aware of is changing industries or positions, especially if the change is going to affect the way you're paid. So if you were getting paid $15 an hour and you change jobs to become a car salesman, and now you're working on commission, that's going to have a negative impact on your ability to get approved for a home loan, because now the lender could require up to 2 years of you being a car salesman, because of the nature is commission, before you could get approved for a home loan. So be very aware of any pending position or career changes and how that might affect your ability to get approved for a home loan. Another thing to consider is that if the way you were paid is heavily dependent on overtime, commission, like we were just talking about, self-employed income, or part-time income, then it's not as straightforward as, hey, I make 20 bucks an hour or I get a salary of $4,500 a month. And most lenders are going to require at least 12, sometimes 24 months of history, especially when it comes to self-employment income, before they're going to allow you to use that income, because it's not considered the same as standard income. So if 1 year in commission you made 50,000 and another year you made 100, what the lender's actually going to do is take both of those numbers, add them together, and then divide them by 24. And that number is going to be what the income is that you're allowed to use. And it's the same with overtime. If you're working 50 hours of overtime a week now, but over the last 2 years you've only worked 5, then just because you're making it now doesn't mean the lender is going to allow it to be used, because they're going to average it over the course of your work history of 2 years. Sometimes a little less if you're going FHA. Maybe it's 18 months or 12 months or something like that. Always at least 12, but many will require 24. So keep that in mind as well if you don't get paid in, I guess we'll call it a normal way. Now, the next thing under your income that we're going to look at, and this is the real important one, because it's going to determine exactly how much house you're able to qualify for, is what's known as your debt to income ratio. Maybe you've heard the term, maybe you haven't, but your debt to income ratio, it has a direct effect on your ability to qualify for a home loan, because it's another part of the guideline that tells us how much of your income we can use and how much debt you have and different things like that. So actually, let's just go ahead and break it down. Your debt to income is your gross monthly income, so what you get before anything else comes out, right? Divided, and then we also take in, not divided, we also take in your monthly debt, as well as other debts like child support, alimony, or different things like that. And then we take those debts and we divide them into your gross monthly income, and that number is what's going to give us the usable amount of income that you have in order to purchase a home. So most loan programs, conventional and FHA, will give you at least 50%. The max on conventional is 50%. Some buyers with a higher credit score will get up to 56%, almost 57% on FHA. But a good rule of thumb is to say 50% of your income divided by your debts. So, just as an example, if you have a $300 a month car payment and $100 a month in credit card bills, then you have $400 in monthly debt. Now, we're also going to add the cost of your house payment. So if you wanted to buy a house that was $225,000 or $200,000, let's say that would cost you $1,200 to $1,400 a month. We'll go with 12. And now that house payment is $1,200 a month. Well, you also have $400 a month in existing monthly debt. So your total monthly debt is $1,600 a month. Let's say you make $5,000 a month. Well, if we're allowed to take 50% of that, then that's $2,500 a month. So as long as your debts, which we just calculated, didn't exceed 50% of that, then you will qualify for the home that you're looking for. You will basically qualify for up to $2,500 a month. So if your total debt in this calculation was $1,600 and you've got $2,500 to spend, then you've got plenty of money left over and plenty of money in your debt to income to qualify for that home. And basically the way we calculate your debt to income is your total debt payments plus the cost of the house divided into your gross monthly income. That's going to give us your debt to income ratio. Now, your assets, what we mean by that is what you have in savings, checking, your 401k accounts, or any other type of monetary account like a CD that you could use to purchase this home to cover your down payment and your closing costs. What will not be allowed is cash in the mattress, cash in a drawer. If that's the situation, then you need to go ahead and deposit that money, and you won't be able to start shopping for a home for at least 60 days because it needs to be seasoned. So you have to season those funds, meaning they have to have been in your account for at least 60 days. And if the underwriter goes in and sees a large cash deposit, they're going to make the lender source where it came from. via paper trail. So if you sold something or where exactly that money came from, and if they can't provide that, then you're not going to be allowed to use those funds to close the loan. And a lot of that has to do with money laundering and different types of rules that are out there to protect the lender. But we're going to look at your bank statements. We're going to look at your checking account. We're going to look at your 401k if you want us to do that, in order to determine if that you have the right amount of money to purchase the home you're trying to purchase. And that, like I said, is going to be your down payment and your closing costs. Now, what happens is we go back 60 days on your bank statements and we review the transactions. So we're not looking for like, oh, you spent $10 here and $12 there. We're looking for cash deposits so that we know if there was, cash recently deposited or anything like that. We're going to go back and we're going to take a look at those because, like I said, the underwriter is going to ask about those. So if you've got cash deposits of $500 and more in the last 60 days, chances are they're going to make us source that. And so the best thing to do with your assets is don't move money around, just deposit your pay stubs, and don't go run in and deposit a bunch of cash, if you can avoid that, because chances are we're not going to be able to use it. And so we're going to look at those bank statements and all of that, like I said, and that's going to help us to determine that you actually have the money you say you do to be able to purchase that home. But again, we can also use things like your 401k, although that's not the best solution. Sometimes people choose to do that. CD accounts, as well as your down payment funds, can also come from a gift from a friend or a family member, close friend or family member. So if any of those options apply, we're going to be looking at documentations for that. Now, if you're buying a home in one of the zero down loan programs like VA or USDA, then you may not be required to provide asset documentation. If we don't need any money from you, then we may not ask you for that. But for the vast majority of home buyers, we're gonna ask for that information because it's the third key in determining how much you qualify for and if you can actually purchase a home. And so if you are buying a house for $200,000, that's 3.5% down, and I'm just going to do the calculation on FHA, that down payment is $7,000. So if your monthly debt to income says you can buy a $200,000 house, but you only have $5,000 saved up, then you may not be allowed to buy a house for that much because your down payment's only $5,000, but you need $7,000. So that can affect your ability to purchase the home you're looking for, and you'd either have to get gift funds or save up the additional amount, because the down payment absolutely has to come from you as the borrower. The seller can't give that to you. No one can give that to you except friends or family members in the form of a gift. And remember, again, a gift means it's not going to be repaid. The lender will actually make your person giving you the money sign a letter that says they're not asking for this money to be repaid, that it is a true gift. So those are going to be the things required in order to pass the asset portion of the three things we look at, which are credit score, income, and assets. Sometimes we call them CIA, but not like the people who, look at your webcam when you're not paying attention. So if you can check off all three of those boxes, then chances are you're ready to go ahead and proceed and buy a home. And determining, your credit score, what you have saved up, those are going to go a long way in helping you understand which loan programs you're going to want to use and work with. And if you have any questions on that, we'd be happy to help you. So hopefully you can take this information and use it and get comfortable and get some peace of mind on whether or not you're actually ready to buy a home. If you need anything, please feel free to reach out. I'm Channing, and I'll talk to you soon.